Good morning, everyone, and thank you for joining us today. I'm excited to present this overview on Castech Ltd, focusing on our share analysis and one-year target price. On this slide, you can see the key details. It's May 2026, and this report is for informational purposes only. We're highlighting our manufacturing excellence, our position as a high-growth SME, and our listing on the BSE. I'll be walking you through our company's fundamentals, recent performance, and future outlook. So, let's dive in and explore what makes Castech Ltd a compelling story. Let's take a closer look at Kalyani Castech Limited, or KCTL, and understand their core business areas and recent developments. KCTL was incorporated in 2012 and is headquartered in New Delhi. Their main focus is manufacturing a wide range of steel and iron castings, finished components, and specialized cargo containers. These containers include various types like ISO 20-foot, 40-foot, double stack, dwarf, cuboid, and other special containers, which are crucial for different logistics and transportation needs. The company serves several key industries, including railways, mining, cement, chemical, fertilizer, and power. This diversification is vital because it spreads their risk across multiple sectors and opens up various growth opportunities. Looking ahead to 2025-26, KCTL has been actively innovating. They successfully trialed stainless steel containers for salt transport, which highlights their commitment to developing more durable and efficient solutions. Additionally, they signed a memorandum of understanding with a Japanese firm to collaborate on ice battery technology, signaling their move into active diversification and cutting-edge technology. As for their financial snapshot, their trailing 12-month earnings per share stand at Rupee 21.95, with a current market price around Rupee 503. This gives us an idea of their valuation and market confidence. Their market cap is approximately 481 crore, indicating a solid presence in the market. Overall, KCTL's focus on diversified industries, innovative product development, and strategic partnerships positions them well for future growth. This aligns with the broader theme of how manufacturing companies are evolving through innovation and diversification to stay competitive in a dynamic market. Now, let's take a closer look at some of the key financial metrics that highlight our strong performance. For FY25, our earnings per share, or EPS, is projected to be Rupee 19.83, which reflects solid growth and profitability. Moving on, our operating profit margin for FY25 is expected to be around 14%, demonstrating efficient cost management and operational effectiveness. When we examine return metrics, our return on capital employed, or ROCE, stands at 29.6%, indicating we are effectively utilizing our capital to generate profits. The return on equity, or ROE, averaged over the past 3 years, is impressive at 31.5%, showcasing strong shareholder returns. Looking at longer-term growth, our 5-year profit CAGR is a remarkable 61%, and our revenue CAGR over the same period is also robust at 197%. These figures underscore consistent growth and the company's ability to expand sustainably over time. Altogether, these financial indicators reinforce our overall theme of steady, sustained growth and efficient performance. They demonstrate our commitment to delivering value to our shareholders while maintaining operational excellence. Let's take a closer look at the shareholding structure. Promoters hold a significant 63.3% stake, which shows strong control and confidence in the company. Domestic institutional investors, or DIIs, own a modest 0.8%, while the public holds around 35.8%. An important point to note is that there are no pledges on these shares, with the pledge release date set for March 2026, which adds a layer of financial stability. Moving on to valuation metrics, the face value per share is Rupee 10. Over the past year, we've seen a compound annual growth rate of 24%, indicating solid growth momentum. The company's earnings per share, or EPS, stands at Rupee 21.95 on a trailing 12 months basis, reflecting profitability. The book value per share is Rupee 103, suggesting the intrinsic worth of the company's assets. The current price-to-earnings ratio, or PE, is 22.9 times, which is relatively reasonable given the growth prospects. The current market price, or CMP, is around Rupee 351, and over the past year, the stock has traded as low as 625 and as high as 503. Looking at the share performance, these figures highlight the stock's volatility and potential for growth. Understanding these key metrics helps us better evaluate the company's financial health and its investment appeal as part of our overall analysis. Let's look at the current market price, which is around Rupee 503. Remember, these targets are based on model estimates, not formal broker recommendations, so investing always carries some risk. Now, the company has several exciting catalysts: ICE battery commercialization, ramping up wagon manufacturing, and a breakthrough in exports. These factors have led to earnings per share, or EPS, beating expectations, and a re-rating that is expanding the price-to-earnings ratio, or PE. For the optimistic or bull case, we're looking at a valuation of about 28 times PE, with an EPS estimate for FY26 of Rupee 32.5, which suggests upside potential of around 81% from the current price, bringing it to about Rupee 910. This scenario assumes steady revenue growth of around 30%, stable operating margins of roughly 13–14%, and a re-rating toward the multiples seen by mid-peer companies. Strong tailwinds from railway and infrastructure sectors support this outlook. In the base case, we see a more cautious scenario. Here, margins might face compression, debtor days could increase, and the order book might slow down. The stock could then re-rate towards the lower end of peer multiples, around 25 times PE, with an EPS of Rupee 26 in FY26, implying a 29% upside to approximately 650. The bear case presents a more conservative view, with margin compression, delays in production, and challenges that could lead to a derating of the stock towards around 18 times PE, with the same EPS estimate of Rupee 26. In this scenario, the stock could decline about 7% from the current level, landing near Rupee 468. All these estimates are based on a forward-looking methodology, multiplying the projected EPS for FY26 by different PE multiples within the peer range, which is between 18x and 28x. Our analyst range for the target price is between Rupee 500 and Rupee 957 by May 2026. So, in summary, these different scenarios reflect how various factors could influence the stock's valuation over the next year, and it's important to consider the potential risks and opportunities as part of your investment decision. Let's now turn our attention to the SWOT analysis and understand the key aspects. Starting with the threats, one of the major challenges we face is raw material price volatility, which can impact our margins unexpectedly. We also face stiff competition from larger players in the industry, which puts pressure on our market share. Additionally, working capital pressure remains a concern, as managing liquidity efficiently is crucial for smooth operations. Production and approval delays can slow down our growth trajectory, and there's also the risk associated with SME listing migration, which could affect our valuation and investor perception. Moving to the opportunities, there's a significant positive outlook driven by the railway and logistics infrastructure boom. The MOU, with a Japanese firm for ICE battery, presents technological innovation potential, and the expansion into stainless steel containers and wagon manufacturing opens new revenue streams. The PLI scheme offers tailwinds, providing incentives that can boost profitability. Moreover, the export market potential remains robust, offering avenues for growth beyond domestic boundaries. Now, looking at our weaknesses, we notice that our debtor days have increased from 47 to 69 days, which indicates longer collection cycles and affects cash flow. Being a small market cap company, around Rupee 481 crore, limits our liquidity, especially on the BSE SME platform, which is known for limited liquidity. Additionally, the declining promoter stake by about 3.84% could raise concerns about confidence levels. On the other hand, our strengths are quite notable. We maintain a near-zero or debt-free balance sheet, which provides financial stability. Our profit CAGR over the past 5 years is an impressive 197%, demonstrating strong growth. Our return on equity stands at 31.5% on a 3-year average, and our ROCE is at 29.6%, showcasing efficient capital utilization. Promoter holding remains strong at 63.3% with zero pledge, reflecting confidence from the management. Lastly, our diversified product portfolio spreads risk and opens multiple avenues for revenue. In summary, while we face certain threats and weaknesses, our strengths and the opportunities ahead position us well for sustainable growth. Before we move on, I want to remind everyone that this presentation is for informational purposes only and does not constitute financial or investment advice. Please invest at your own risk. Now, looking at the promoter holding, it's quite significant. 63.3%, comprising zero pledged shares as of March 2026. This zero encumbrance actually reflects a high level of confidence from the promoters in the company's future growth prospects. Switching gears to the company's technological and strategic initiatives, we've seen a strong promoter commitment, especially highlighted by the MOU with a Japanese firm for ice battery technology. Plus, the successful trial of stainless steel containers opens up new revenue streams beyond their core casting and container business, which is a promising sign of diversification and expansion into new ventures. Financially, the company has a near-zero interest burden and has been consistently reducing its debt. This kind of financial flexibility is crucial, especially in a capital-intensive manufacturing sector, because it allows reinvestment and growth without the burden of heavy debt. Looking at sales and profits, the growth has been remarkable. Sales have grown from just 13 crore rupees in FY20 to an estimated 139 crore in FY25, which is a compound annual growth rate of 61%. Even more impressive is the profit growth, which has a CAGR of 197% over 5 years, highlighting exceptional operating leverage and a lean cost structure. Overall, this high growth trajectory in revenue and profits, combined with strong promoter backing and strategic diversification, really encapsulates the investment thesis for this company. It's a compelling story of growth, confidence, and long-term potential. Let's take a closer look at some of the key metrics and projections for this company as of May 2026. Starting with ownership, promoters hold a significant 63.3%, indicating strong promoter confidence. Interestingly, there is no promoter pledge on shares, which is a positive sign for stability. The dividend payout is near zero, suggesting the company might be reinvesting earnings into growth rather than distributing dividends. In terms of financial health, the debt status is quite manageable, with a debt-to-equity ratio of around 4.9 times. The price-to-book ratio stands at approximately 4.9x, and the current price-to-earnings ratio is about 22.9x, which provides some perspective on valuation compared to earnings. Looking at the one-year target prices, there's a range of outlooks: a bear case at 468 rupees, a base case of 650, and a bullish scenario reaching 910 rupees. Currently, the share price is around 503 rupees, which suggests some room for growth depending on how market conditions evolve. Now, examining the financials over the past few years and projections. Revenue has grown steadily from 63 crore in FY23 to an expected 185 crore in FY26. Operating profit has also increased. Although the operating profit margin has slightly declined from 19% in FY23 to around 13% expected in FY26. Net profit follows a similar upward trend, from 8 crore in FY23 to an estimated 19 crore in FY26. Earnings per share have risen accordingly, with a projected EPS of about 26 rupees in FY26, reflecting improved profitability on a per-share basis. Return on equity, which measures how effectively the company is using shareholders' capital, is around 38% in FY23, but is expected to stabilize at about 25% by FY26. Overall, these key metrics suggest a company with a strong growth trajectory, improving profitability, and valuation metrics that could present attractive opportunities depending on market conditions. This snapshot helps us understand the company's current position and potential future performance within our overall investment framework.